Welcome to Tax Smart Investing presented by BCR Wealth. Our investment and financial planning teams work together to enhance the expected after-tax return for our clients. So today we brought together experts from both groups to present. Success comes from focusing on getting the most out of the areas you can control and limiting the time you spend on things that you can't control. You can't control what the weather will be on a sailing trip you're planning a year from now, but you can prepare to have all the right equipment you will need to maximize your success no matter what the weather ends up being. As advisors, we can't control the market, but we can use planning to help our clients maximize their success whatever the market ends up doing. Our job is to help people focus less on things they can't control, like the market, and more on things they can control. Financial planning provides many key areas to focus on that you can control. One of those areas is making sure you aren't generating unnecessary taxes. No one wants to pay more than they should in taxes. The problem is you don't see the taxes you don't pay, so everyone's taxes feel high to them when it's time to pay them. Clients and non-clients alike have asked us for years how we keep taxes low and provide a higher expected after-tax return than those that just invest in what they think will go up next. Today, we're going to focus on number one, demonstrating the value that incremental tax savings compounding over several years can have on overall investment performance. And then number two, sharing the strategies we use to reduce taxes and increase investment performance.
Several large financial institutions have done research on the value that comprehensive financial planning and investment management can provide in net returns. These firms include Vanguard, Morningstar, and Envestnet. As you can see on the chart on the right, these values can range from 1.59% all the way to 3%. Obviously, this value can vary based on the client situation, circumstances, as well as the type of advisor that they are working with. So of these firms mentioned in the past slide, all of them attribute a portion of this value add to tax smart investing strategies. In this table on the right, tax management, you'll see added around 1%, and asset selection and allocation at around 0.52% of this net value in returns. Some of the strategies used to achieve this are different account types, tax efficient asset allocation, as well as tax efficient asset location. Some of the other value add-ins you'll see here attribute to financial planning, investment selection, and rebalancing. Morgan Stanley has also done research on the value comprehensive financial planning can add. According to a 2022 paper done by Morgan Stanley, $1 million portfolio earning 7% over 20 years can produce an additional $322,000 by reducing this tax drag. What this tax drag is what you receive after all tax has been paid when realizing your gains. This can be reduced by being tax aware when choosing asset classes, location, and allocation, which we will cover in the upcoming slides.
We recognize that our clients have different levels of tax knowledge. So we're going to start with some information to try to get everyone in the same place before we give you the higher details. Please bear with us, whatever tax knowledge you brought to the table. Getting on the same page is going to be how investment accounts affect your taxes and tax impacts of investment vehicles. The details are going to be tax impact of asset location and implementation of the art versus the science.
So as Marshall mentioned, to get everybody kind of on the same page, I'm going to go over the different types of investment accounts and how they impact your taxes. Investment accounts can be broken down into three broad categories. The first is what we refer to as a taxable account. This is just a normal brokerage investment account. We call it a taxable account because it has yearly tax impacts through taxable dividends received and any capital gains or losses realized during that year. With this type of account, you get a 1099 at the end of the year showing all your dividends and capital gains realized during that year. The next two types of accounts are what we call tax advantaged accounts because they allow you to defer or eliminate the annual tax impact of your investments, meaning you would not get a 1099 at the end of each year. They're either post-tax Roth accounts or pre-tax traditional accounts. On the next couple of slides, I'm going to get into the details of comparing the two tax-advantaged accounts, the Roth versus traditional comparison, and then after that, Tim will go over the taxation of taxable investment accounts. So as JD mentioned on the previous slide about the Morgan Stanley study and the importance of avoiding tax drag from having to pay taxes annually on your dividends and realized capital gains, and how it can have a huge impact over the course of a 20 to 40 year time period while you're saving for retirement. The good news for both traditional and Roth accounts is once the money is in the account, they both avoid tax drag and they grow without any annual tax reporting requirements. The difference between the two accounts is whether you want to make tax-deductible contributions during your working years or tax-free withdrawals in retirement. So first, we're going to look at a comparison of the two accounts during your working years while you're making contributions into the accounts. Traditional retirement accounts allow you to take a tax deduction for any contributions that you make. With a traditional IRA, this gets deducted as an adjustment on your tax return. In the case of a 401k, this usually happens behind the scenes because you contribute automatically through payroll deductions. So instead of a deduction on your tax return, the amount you contributed is just not reported to you as taxable income on your W-2. You get the same result, it's just reported slightly differently. In comparison, Roth accounts have no impact on your taxes in the year that you contribute to them. With both accounts, once the money is in the account, there's no need to report any dividends or capital gains on any buying or selling that's done in either type of account. There's no annual tax drag, as we've mentioned. There is a significant difference once you reach retirement age and you start to take money out of the account. Traditional accounts, you've got to pay ordinary income tax on the full amount of the withdrawal. We often see some confusion where people think that because these are investment returns that they get capital gains treatment, but that's not the case. All withdrawals are fully taxable at ordinary income tax rates. Roth accounts, on the other hand, you can take the full withdrawal amount completely tax-free. All right, let's run through a quick example to better illustrate the difference between the two accounts and how this often plays out in real life. We'll start with what it looks like contributing to a traditional account. Let's assume that you have a gross paycheck of $15,000 and you make a traditional 401k contribution of $750. That leaves you with taxable income of $14,250. For our example, we're going to assume you're in the top tax bracket equal to 37% or $5,273 in taxes. This results in take-home pay of $8,977. In comparison, if you had the same paycheck, but you instead made a Roth 401k contribution, you'd pay taxes on the full $15,000. This results in $5,550 in taxes. Then after you make your Roth contribution, the same $750, you'd have a net take-home pay of $8,700. As you can see, that's a $277 difference compared to the traditional account. Then let's fast forward to retirement, and we'll assume that both accounts have doubled in value from investment growth. So now each account has $1,500 in it. When the traditional account owner wants to access that money, they'd have to pay ordinary income taxes on the full amount, equal to 37% in our example, or $555 in taxes. And that would leave them with $945 to spend in retirement. The Roth account owner, on the other hand, they get to access their money completely tax-free. And they can spend the full $1,500 in retirement. So as you can see, in retirement, they get a $555 benefit on the Roth side. So this might lead you to believe that we always recommend Roth accounts. However, you'll notice in our example that we use the same 37% tax rate for both the year of contribution and also in retirement when the money is taken out. Rarely are those the same rate. There's often one that's higher than the other based on your income and your desired spending in retirement. So the should I contribute to Roth or traditional question should really come down to, is your current tax rate higher or lower than your future tax rate? As you can see on the slide, when your current tax rate is higher than your future tax rate, you'd want to make a traditional contribution so that you can deduct as much as possible against that higher tax bracket. And then the opposite is true for the Roth. If your current tax rate is lower than what you think your future tax rate will be, then you should make a Roth contribution so that you can take tax-free withdrawals when you're in that higher tax bracket. The hard part, obviously, is knowing what your future tax rate will be. This is a situation where I think working with a CPA or a financial planner can be beneficial because there are a lot of variables to consider when you're trying to project what that future tax rate will be. For example, one of the considerations that's been on our mind a lot lately is potential law changes that will affect future tax rates. As it stands right now, many of the 2017 tax cuts are set to expire at the end of 2025. And this will cause many to jump into a higher tax bracket, even at the same income level. And we don't know yet, what other potential law changes could be coming over the next 10 to 20 years. The part that's more knowable is your current tax rate. You can sit down with your CPA or financial planner and project out what your current year income will be, pretty closely. And you can determine which tax brackets you'll fall into. Doing this will allow you to take advantage of opportunities to switch between Roth and traditional contributions, depending on where your income is at for the year. We often see clients experience different life events that will result in large temporary changes in income. And this allows them to take advantage of switching between Roth and traditional contributions, depending on where their income is for the year, to greatly reduce the amount of taxes they pay over their lifetime. And that's what we'll look at on the next slide. Okay, I think this is a great illustration. It's probably my favorite slide in our presentation. What it shows is this blue line that represents the taxpayer's taxable income. It shows how it changes over time throughout life, from age 25 all the way through to retirement. And then on the vertical axis is their tax bracket. And you can see it's shaded blue down here at the bottom for these lower brackets, where it recommends contributing to a Roth account to take advantage of your lower tax bracket. And then it's shaded yellow at the top, where you should most likely be contributing to a traditional account so that you can deduct as much as possible against the higher tax brackets. And then all these different points in time where you might experience a big change in income, are these different life scenarios. They might not all apply to you, but at least some of them are probably relevant to everyone. And it's some examples that are on here, some opportunities where you might experience a drop in income. Maybe you're just starting out in your career, or you decide to go back to school. Maybe you're starting a business, or one spouse might decide to stay home with the kids, or even retiring early. These are all opportunities to take advantage of getting money into Roth accounts, either through Roth contributions or Roth conversions. So that's years where your tax bracket is low, and you experience a drop in income. The opposite is also true when you experience a sudden increase in income. This could be from a big bonus at work, a promotion, maybe you're self-employed, and you sell your business or you sell an investment property. These are all great times to maximize your contribution to a traditional account and try to shelter as much income as possible from being taxed at those highest tax brackets. I like that this chart also has the middle section here in green. This represents like the 24% tax bracket, and it suggests doing a 50-50 split between Roth and traditional contributions. As you'll see later in our presentation, if you can build up both of these accounts, the Roth and traditional, and then also a taxable account like Tim is about to go over, if you have all three of these accounts going into retirement, it unlocks some opportunities for some really tax smart investing strategies, tax smart withdrawal strategies that allow you to control what your taxable income is in retirement, and it gives you better spending flexibility. So again, back to the question, should I contribute to Roth or traditional? I think the answer is yes. The more important question is, when should you contribute to Roth versus traditional?
As Jake mentioned, investment accounts can be broken down into three broad categories. He covered the retirement accounts. I'm going to talk about the third type, which is what industry professionals refer to as an individual or joint taxable account. It is referred to as a taxable account because it has yearly tax impacts through taxable dividends received, any capital gains or losses that were realized during that year. These accounts can be used for long-term goals, not specifically designed for retirement, like buying a house, a boat, or to pay for a vacation. These accounts can also be used to diversify revenue streams in retirement. A taxable account or non-retirement account is best utilized when holding investments for more than 1 year. This allows for preferential tax treatment at a lower rate than most investors' income tax rate. If you sell investments for a gain after 1 year, the tax rate for most investors is 15 or could be 20% for high income earners. To show this visually, we start with what we call your savings or investments, also known as your cost basis. Shown here on the left-hand side, we have long-term capital gains and qualified dividends. On the right-hand side is short-term and what is considered ordinary dividends. As you will see, an investor is taxed on the growth of the investment at the long-term capital gain rate at 15 or 20%, again depending on your income. When it comes to short-term capital gains, investors are taxed on the growth of the investments at their ordinary income tax rate. Of course, you net your cost basis or original purchase price against the total value when sold, and you owe taxes on the growth. Again, the tax rate depends on the length of time you hold the investment or if the dividends are considered qualified or ordinary. Here we have an example of an investment of $750. Let's say the investment grows by an additional $750, giving you a pre-tax value of $1,500. You have $750 of growth. If you sell this investment after holding it for at least 1 year, you will be taxed at the long-term capital gain rate. In this example, we use 20%. If you sell, you owe $150. This gives you an after-tax value of $1,350. Now let's take a look at the right-hand side. Same investment, you invest $750, you have $750 of growth. Held less than 12 months, you owe $277.50, giving you an after-tax value of $1,222.50. You might say, wow, Tim, that doesn't make a big difference. Keep in mind, we're using small numbers here. If you extrapolate this out with more money invested, it does make a big difference. So you might be wondering, which account type should I have? Well, each account type can be utilized depending on your situation. They are all beneficial. The non-retirement accounts, as mentioned, can be used before retirement age to fund long-term goals and/or retirement. As mentioned, when investments are held for more than 1 year, you receive preferential tax treatment. Roths, on the other hand, are designed for retirement. They grow tax-free. We want as much as we can get in these accounts for the tax-free growth when you do take withdrawals in retirement. And finally, deferred accounts. They're really only beneficial in the year you make the contribution. This reduces your tax income for that year, but every year thereafter, this is growing a future tax bill once you eventually do take the distribution. We often meet clients that have large deferred accounts that haven't utilized non-retirement or Roths when saving and investing. This causes clients to have a large tax bill each year in retirement because withdrawals are taxed at your income tax rate. It is very important to diversify your revenue streams. Say, for instance, you're in retirement and need a roof or a car or some other large expense. In the deferred account, you will have to pay a much larger tax bill adding to your income. You would much prefer to take the money from your taxable or non-retirement or Roth to not increase your tax rate.
So now let's go over the tax impact of different investment vehicles. ETFs versus mutual funds. Historically, you could target institutional mutual funds that took advantage of tax efficiency to help keep your inter-year taxes as controlled as possible. The introduction of ETFs have brought even more tax-efficient opportunities to the table. When trading ETFs, you have more control over the price you're trading because ETFs trade throughout the day like a stock, rather than once at the end of each trading day like a mutual fund. Additionally, institutions tend to not charge commissions when trading ETFs, whereas they do charge commissions when trading mutual funds. Tax triggers from investing. ETFs tend to not have capital gain distributions at the end of the year like mutual funds tend to. Because of this, we prefer to add ETFs to a taxable account. We prefer to buy mutual funds in a retirement account such as an IRA or a Roth, because when those capital distributions are paid out, if that mutual fund is held in a retirement account, you're avoiding that current year tax liability that you would have if that mutual fund was held in a taxable account.
Let's jump into the details. Tax impact of asset classes is where we see some of the best opportunities to enhance after-tax return. Likely you've heard the term asset allocation, but it gets confusing because asset location sounds very similar. So let's first start by thinking, okay, what is asset allocation? Hypothetically, you have $1 million in different accounts. Allocation is how much you put in different asset classes in the total $1 million. The next decision is asset location. Based on the tax impact of each asset class, you have to decide which account to put each asset class into. It gets complex because you're not just looking at the lowest taxes today. We're looking at the highest after-tax net worth you can get over your lifetime.
So the first asset class we'll take a look at are real estate investment trusts, or REITs. So REITs are a company that owns income producing real estate, providing a great way to passively invest in real estate. We consider REITs an inefficient asset class as they generate ordinary income and are required to distribute at least 90% of their taxable income to shareholders. Some of the other key details of REITs are that they are volatile with high long-term growth opportunities, and most delay their 1099s, which can cause tax filing problems. Because of this high long-term growth opportunity, we prefer to put them in Roth retirement accounts, and the least preferred placement is the non-retirement account due to this ordinary income that is received every year.
Fixed income. So we see fixed income as an inefficient asset class because fixed income products generate regular income and is taxed as it is earned. So we prefer to have fixed income in a deferred retirement account such as an IRA or 401k. We're using fixed income to act as a defense to the volatility of the market. We're not relying on fixed income for the growth and performance of the portfolio. Because of the nature of fixed income, we do not want to have fixed income in a Roth, since assets in a Roth grow tax-free.
When you hear domestic equity, I want you to think U.S. stocks, like many of the logos found here on this slide. These investments are generally the largest part of an investment portfolio and what we rely on for growth. Seeing as how this is the growth portion of the portfolio, it is best to hold these investments long-term for preferential tax treatment like we discussed earlier. Many clients ask us, how do we beat inflation? The answer historically has been stocks. Stocks have historically provided returns that outpace inflation. To take our conversation a step further to something a little less talked about, but is very important, is placement. We prefer to have growth stocks in a Roth or a taxable account. If in a deferred account, you're growing a future tax bill. When in a Roth, it is tax-free. And as we discussed earlier, when held in a taxable, non-retirement account, you have preferential tax treatment after 1 year. Of course, each client situation is different, and we may invest equity in any one of the 3 account types.
Foreign equities, these are non-U.S. stocks. They're usually held to increase diversification. They're more volatile than U.S. stocks, but they can have higher expected returns. For that reason, they're best held in Roth accounts due to the higher expected growth. Or in certain situations, it can be useful to hold them in a taxable account, since the increased volatility allows for tax loss harvesting opportunities, and any foreign sourced income, such as dividends from your international stocks, that could be eligible for a foreign tax credit that you'd only get a benefit from if it is in a taxable account.
Alternative investments, private equity, commodities, digital currency. People try to lump these together, but you shouldn't. As a matter of fact, sometimes an investment in the same one of these categories has the opposite tax impact as another one in the same category. Frankly, when we look at these, we think a lot of people use them to speculate. They're not actually investing. But if you are investing in these, realize there are some that are efficient, there's some that are inefficient. And so you're going to have to look specifically at that investment and understand what it is doing to understand the best place to put it.
The implementation of a portfolio is an art versus science. So let's take a look. So we often see a whole portfolio in one account, but that's not the most tax efficient way to invest when you have a combination of accounts like a taxable, Roth, deferred accounts, etc. Like Marshall said earlier, asset location is an important factor to take into consideration when implementing a portfolio. We say investing by household is tax smart. It tends to be more favorable to the investor. We would much rather prefer to buy the majority, if not all, of your fixed income in a deferred account when possible, because real estate is subject to different taxation than other equity holdings. We want to keep that away from taxable accounts if possible. There is no such thing as the perfect portfolio. That's okay. Every portfolio is different and can have its own unique challenges. The implementation of a portfolio almost always requires a little creativity, but taking that time can really pay off from a tax standpoint in the long run. We have a saying, don't let the tail wag the dog. We don't put tax considerations ahead of diversification, rebalancing, and risk in a portfolio, but it's always a part of our decision making.
Thanks for watching Tax Smart Investing presented by BCR Wealth. For more information on these topics and many more, please check out our blog.